All right, seniors, welcome back. How someone might be wondering about this one. I just realized that I didn't use the 0.6. Okay, the 0.6 should be part of the items in the statement of profit or loss. So it's supposed to be other income. Okay, so we have other income. So we have other income to be 0.6. So it's an amount that they are going to pay to Akuma when those people produce above the limits, and they have done that. They have produced above the capacity. So it means that they have to pay to Akuma. So this particular amount will be a revenue or be an income for Akuma. So I didn't include that. So take note of that. All right.
Yeah, okay, yeah.
All right.
Please,
So
how did you get this thing, the 2.6, the interest?
the 2.6, I just calculate the interest rate, which is 8.98 on the amount that they are currently owing, 28.4. So the 8.98 multiplied by 28.4.
Oh, okay, okay,
Yeah,
okay. All right.
yeah. All right. So because of the time, we are going to do sell and lease back reassessment next week, Saturday. So we just do the normal list, which is the Leasee accounting today, right now, maybe because we have to close 6:30. So we just do the Leasee accounting, then we push the sell and lease back and also the reassessment of the lease liability to next week. The reassessment, sell and lease back is reassessment is purely for corporate reporting because financial reporting, what are you going to do? They cannot ask that is above your level. But anything can happen. But sell and lease back, they can ask for financial reporting too. Okay.
Good morning, sir.
Yes, yeah.
Please, I hope we will get the news.
The note.
I mean, the workings.
Yeah,
Yeah.
yeah, yeah, yeah. I will save it and send it to you.
All right. Thank you
All
so
right,
much.
all right, all right. So let's come to, we are done with the Leases accounting. So try the question two. You can try it and put your work on the pitch so that people will look at it and wherever you're having faults, they will assist you or we assist you. Okay. So let's come to the Leasee accounting. The Leasee accounting is a person who is going to use the assets. So the operating lease, the Leasee will just pay the renters and use the asset. No recognition of the asset. So as at when you pay the renters, you recognize it as what? Rental expense in the profit or loss. But if you pay in advance, the excess payment will be treated as current asset. If you are owing some parts, that particular owings will be treated as current liability. That is all. So if you are to pay 10 million over 20 years, that is that is operating lease. You are paying 10 million for what? For 10 years. So at the end of every year, how much are you taking there? You just spread the 10 million over the 10 years. That is all. So every year you are sending 0.5 million to the profit or loss. That is for the operating list. Our focus is on the finance list. Our focus is on the finance list. So we have the Leasee accounting. The Leasee is the person who is going to use the asset. We have done the Leasee accounting already. Okay. So the Leasee accounting, we are looking at the basic one. So you have taken an asset from someone and you are going to incur insurance costs, maintenance costs. If the asset is missing, you are going to replace the asset. So in this case, it is as if the asset is your own asset. Okay. So if you are going to use the asset, what you do is that you have to first recognize the asset. So you have to first recognize the assets. So at what cost are you going to recognize the assets? So the Leasee the lessee will recognize the asset, which is always the right of use. Recognize the right of use. And they also recognize what we call the amount that they are here to pay. The amount that they are here to pay, which we call the lease liability. Okay. So let's look at we are saying that under the finance lease, it is as if the lessor is selling the asset to you for that particular number of period. So the question now is, you are going to take the assets on credit, and the person is saying that, okay, you have to pay these amounts over this number of years. The question is, if you should have money that day and pay the person, how much are you going to pay? You see the 5 million that the person is paying, that you should pay the 5 million at the end of every year or at the beginning of every year. Because you are going to have this money to be with you, the person has factored in time value of money. So in actual sense, if you should have the money today to pay, you will not pay that amount that you are going to pay over the lease period. So the question now is, if you should have money today and pay for the lease or to pay for the asset, what will be the amount? Because the transaction is happening today. That is why we present value all the rental payments together with any necessary figures that you have to present value. So the right of use will be recognized initially at the minimum lease payment amount. Then if there is any direct cost, the direct cost can be handling cost, it can be delivery cost, it can be installation cost, because if the asset is being given to you, the asset might not be given to you in a condition that you can start using it immediately. So what you have to do is that if it is plant, you have to come and install the plant on your premises. So you are going to incur installation cost. It's a cost that you have incurred to bring the asset into a condition where you have to start using it. So that particular cost will be added to the right of use. So if you have taken the lease liability, this is the amount that I have to pay for the asset. So this is the amount that I have purchased the asset from the person, all things being equal. But I've incurred the handling cost, I've incurred delivery cost, I've incurred installation cost, I've also incurred maybe site preparation cost, any cost that you incur to bring the asset to a state that you are going to use it, that particular cost must be added to the right of use. It's just like how initial cost of what asset is calculated under 16, IS 16, property, plant, and equipment. So, okay, this is the lease liability. This is the amount that I'm owing the lessor. So it means that if I should have the money to buy the asset, this is the amount that the lessor will sell the asset to me. Fine, that is the cost. That is the price of the asset. But what are other costs that I've incurred to bring the asset to the stage that I can start using it? I've incurred handling costs, I've incurred delivering costs, I've incurred installation costs, I've incurred site preparation costs. Or sometimes part of the contract will say that at the end of the lease period, the lessee must what? Decommission or dismantle the asset. So the lessor must make provision for that particular cost, like IS 37 provisions. So all those things can be factored into the lease, especially the lessee accounting. The lessee, the asset can also be at maybe uncompleted building where you are going to lease it. Okay, it means that you have to complete the building yourself. So you are going to incur a material cost of all those costs that you are going to incur to bring the building to the state that you can start using it. All those costs must be added to the lease liability, the amount that you are paying for the uncompleted building. Okay, Rob, your hand is up. I want to continue, but your hand is up. So let's take your question. Then we move on.
So, with regards to the decommission costs,
Yeah.
would it be treated like the way you treat the site preparation, the delivery cost, or that one, the provision that you are saying you make for the decommission cost?
Okay. Okay.
The treatment is different.
Let me just assume that you haven't heard about IS 37 before. Okay. The issue is, you see that the dismantling will be done at the end of the lease period, isn't it? So what we do is that we normally estimate the amount that we are going to incur at the end of the lease period. So the question can say that the the company will bring the assets to its original state at the end of the lease period at a cost of 30 million. This cost will be incurred at the end of the what? The lease period. This is a future value. So if the decommissioning should be done today, if the dismantling should be done today, at what cost are we going to do that? So we try to present value this. So if you present value that, that is today's cost, then you add it to the value of the assets. Then what you do is at the end of every year, you compound this to get your 30 million. At the end of every year, you compound the what? The present value of the 30 million. So that at the end of the lease period, you get your 30 million. It is being done in relation to how dismantling cost is being taken care of under IS 37 provisions. All right.
Okay. Thank you.
All right. I was talking about you leasing uncompleted building. It means that you are going to what? Complete the building before you use it. But the thing is, since the person has started the project already, the person can say that, okay, take it. I'll give you, you pay this amount at the end of this. It means that you present value the amount that you are going to be paying and assume that that is the amount that you are paying for the building. Okay. But you have to complete the building yourself. You are going to buy materials, you are going to incur labor, all those costs that you are going to incur to bring the asset or to bring the building to a state that you can start using it. Those costs will be added to the initial cost of what? The building. There can also be a situation where you go for a loan to complete the building. So the building will take some time to be ready. It means that the loan that you are going to be taking will be what? Will fall under borrowing cost. So you are going to pay interest on the what? On the loan. So if it takes you 6 months to complete the building, it means that the loan that you have taken to finance the building, 6 months of the interest must be added to the initial cost of the asset. So you have to take note of that. All right. So for the lease liability, how do we calculate the lease liability? How do we calculate the lease liability? Let's look at how we calculate the lease liability and also how we calculate the right of use. Okay, let me take the right of use first. So what are the things that we are going to be including in the right of use? Okay. The right of use, the first one is the amount that we are owing the people today. That is the amount that we are paying for the asset. Okay. So we have the minimum lease liability or the minimum lease payment. Minimum lease payments, which is the present value of all the lease rentals together with any necessary costs. Then we have the direct costs. Mostly the question will give you direct costs. This direct cost is just all the costs that you have incurred. It can be the component of the handling, installation. So they just put all of them together and have the direct cost. Okay. And this direct cost, the lessor might decide to pay part of it. So if the lessor has decided to pay part of it, what will happen is that you only what? Add the portion that you are paying yourself. So the cost can be 5 million. The lessor will agree to pay 2 million. It means that you have incurred 5 million, but they have what? The lessor has refunded what? 2 million. So the only cost that you are going to add is the 3 million to the right of use. You can also add the dismantling cost, which is always at the present value. Okay. So you can also add any other cost that you have incurred, or that's a cost that you have necessarily incurred to bring the asset to a state that you can start using it. Any cost that you incur to bring the asset to a state that you can start using it, that cost must be added to the right of use, the initial cost of the right of use. Okay. The subsequent measurement of the right of use. The lessee must decide it, or the lessee can decide to either use cost model or revaluation model for the right of use. It's allowed. Subsequent measurement, the lessee can decide to use revaluation model or cost model. Any of them that they are using, you know how to go about it. Property, plant, and equipment. The lease liability. What forms the component of the lease liability? Okay. The lease liability, the initial measurement what are the things that we use? So the lease liability, what are the things that we use? We use the rental payments, the annual rental payment or the monthly rental payments. It depends on how they are going to pay it. This can either be fixed and variable. I've spoken about the fixed and variable already. So we can also have maybe this one we use the guaranteed residual value. They are the guaranteed residual value. Guaranteed residual value. We use options price if it is certain that the options will be exercised. We also use termination penalties if the lessee is certain that due to certain things they are going to terminate the contract. We can also include that. And what else again? These are the basic things. So let's come to the subsequent measurement of the right of use. I say that it can be cost model or revaluation model. The lease liability, it will be amortized because you are owing this amount and you have agreed that you are going to pay the person 8% interest on any amount that you are owing. Just like a loan, you amortize it. So you calculate the interest on the amount that you are currently owing, then you subtract the amount that you have paid. You get a remaining balance. The next year you do the same thing. Okay, let's come here. Let's look at how we determine the lease period. The lease period. Okay, they can give you a question where they will not give you the lease period, and you now have the decision to determine the lease period. You will now have the decision to determine the lease period. Okay, the lease period, in most cases, it can be given to you in the question. Sometimes they cannot give it to you. But if you have the useful life of the asset, the useful life of the asset is 5 years, and you are leasing the asset for 8 years. It doesn't make sense. The remaining useful life of the asset is 5 years, and you say you are going to lease the asset for 8 years. What is that? So if this is the case, you use the what? The 5 years. You use the period that is shorter. So you use the remaining useful life rather than the what? The lease period. So it means that the calculation of your lease liability will be based on what? 5 years, not 8 years. But if the lease period is 5 years, the useful life is what? 8 years. It means that you're going to use the asset for what? For 5 years. Okay. So let's assume that the lease period itself, the one given to us is 5 years. But the lessee has the option to extend the contract by additional 2 years. So it means that in all things being equal, it will be 7 years. You can only add these 2 years if the lessee is certain that they are going to what? Exercise the option. So if they are certain that they are going to exercise the option, it means that we are going to add additional 2 years, making 7 years. Okay, that is nice. If the lease period is 5 years, the lease period can be 5 years. And the lessee is saying that we have the option to terminate the contract at the end of 5 years. Okay, the question is, ask yourself, is the lessee certain that they are going to terminate the contract? If yes, then the lease period will no longer be what? 5 years. It will now be 3 years because we are going to use the asset for 3 years and terminate it. And that is where the termination penalties will come in when we are calculating the lease liability. But if the option to terminate is there, but it's not certain that it will be exercised, you still use your 5 years. So if the lease period is 5 years and the lessee is saying that, or they have the option to terminate the lease at the end of the 4 years, and they are certain that they are going to terminate it, it means that the lease period is now 4 years, not 5 years. All right. Okay. So let me pick a question. Then we just solve maybe at least 2 within the 30 minutes. Then we send the rest to next week, Saturday. All right. Any question before we move on? Rob,
Sir,
any question for me?
no, please.
Okay. All right. So someone should take this one for us. Okay, let me bring the second one too so that we can be looking at all the two. Okay. So someone should take the question for us. Who is going to do that for us? Someone should read the question for us, question 3. Or you can't see.
Optimism Limited entered into the following agreements. On 1st January 2020, OL leased a machine from Fascinated Bank Limited. Details are as follows. The lease period is agreed as 6 years. However, the lease contains an option for OL to terminate the lease at the end of the 4 years upon payment of 1 million Ghana cedis. OL is reasonably certain to exercise this option due to anticipated technological changes. First annual installment amounting to 12 million cedis was paid on 1st January 2020, and all subsequent annual installments are payable on 1st January, subject to decrease of 2 million in each year. Market rate for similar transaction is 12% per annum, but as an incentive to OL for entering into the lease, FBL has incorporated an implicit rate of 11% per annum, which is known to OL. The fair value and useful life of the machine are 40 million cedis and 7 years respectively. OL incurred initial direct cost of 3 million. Okay, On 1st May 2021, OL entered into an arrangement with Energetic Limited for the use of 5 photocopy machines for a non-cancelable period of 3 years. Semi-annual installment of 2 million is to be paid in advance. As per agreement, EL has a substantive substitution right to replace the machines. Required: A. Prepare relevant extracts, including comparative figures from OL's Statement of Financial Position, Statement of Profit or Loss, and note to the financial statement for the year ended 31st December 2021. B. Compute the unguaranteed residual value estimated by FBL at the end of the 6 years if FBL had incurred 2 million cedis of initial direct cost. Assume that FBL is reasonably certain that OL would not exercise termination option.
Okay. So this is very interesting. So, okay. So you can see this is just a normal list question with some kind of things that you haven't seen before. Okay. So the lease period is what? The lease period is
6 years.
6
6
years.
years.
6 years.
Okay. But they added something like however or something like that. However, the
Yeah,
lease
termination,
contains an
termination.
option. Yeah.
Option of
So okay. So however, the lease contains an option for OL to terminate the lease at the end of the 4 years upon payment of what? 1 million. So the penalty for termination is how much?
it's 1 million.
Okay. But the question is OL certain that they are going to terminate the lease at the end of the 4 years?
Yes, please, because of technological changes or something like that.
Okay. So right now, what will be the lease period?
So we use the 4 years.
Okay. The lease period will now change to what? 4 years. The lease period will now change to what? 4 years. We terminate it and we return the asset to what? To the owner at the end of the 4 years. We are not going to use the assets for the remaining 2 years again. But if the question says that the leasee is not certain about this particular option, then you still use your 6 years. All right. First annual installment amounting to 12 million was paid on what? 1st January 2020, and all subsequent annual installments are payable on 1st January, subject to decrease of 2 million in each year. So how are they paying these particular rentals? Is it in advance or in arrears? The rentals in advance or in arrears?
In advance.
Okay, in advance. So the first amount was paid on what? 1st January 20.
2020.
Okay. The second one will be paid on what? 1st January 2021, isn't it?
21, yeah.
How much are they going to pay?
To be less 2 million.
And that will give us 10 million, isn't it?
Yeah.
The subsequent one will be how much?
8 million.
The subsequent one will be how much?
8 million.
No, it will be 6 million. We have the 8 million already.
6 million. Yeah.
That will be 6 million. So
And
we'll
then
get
the last one before 4 million.
okay. So we'll get that so that we can compute our lease liability very well. Okay. Market rate for similar transaction is 12.5, but as an incentive of OL for entering into this one. So we just use the implicit rate, the rate implicit in the list. That is the rate that the two parties have agreed on. So we are going to use the 11%. The fair value and useful life of the machine are this. This is relevant for the lessor, not the lessee. Okay. OL incur initial direct cost of what? 3 million. This initial direct cost, we can say that any cost that they have incurred to bring the asset to the state that they can start using it. It can be handling cost, installation cost that they put together to have the 3 million. So let's start working now. Let's start working. So the first thing that we have to do is to calculate, first of all, we have to know how our lease liability will be computed. So let's look at the rental payment one by one. So the first one, 2020, we are paying the rentals. 2020 is 12 million, isn't it? 2021, the rentals will be 10 million. Am I correct? 2022, the rentals will be 8 million. 2023, the rentals will be 6 million. Okay. Is that all? Because they are going to terminate. So it will be for only 4 years. Are we okay?
4 years.
Okay.
Yeah.
But this 12 million is already paid, isn't it? This 12 million is already what? Paid. So they are not owing the 12 million. This is the amount that they are owing. This is the amount that they are owing. So what we do is that we just calculate, the lease liability is always calculated for the amount that they are here to pay. So what you have to do is that you only present value this amount. Or if you like, you can also add a 12 because the 12 will still be 1.0 because this is today. The present value of the 12 is still the 12 million. But we only calculate the lease liability based on the amount that they are here to pay. The amount that they are owing, we present value those amounts. Okay, so the lease liability, let's calculate the lease liability. So the lease liability, the computation of the lease liability will be, let's have 2021. Okay, let me just put the years here. We have the years. We have the years. Shit. All right. We have the why? Okay, we have the years. We have the cash flow. We have the discount factor. Then we have the present value. So we are doing this in 2020, but we have already paid. So we start with the 2021. We start with the 2021. So we are in 2020. The second amount will be paid in 2021. So this is in a year time. So we start with 2021. Okay, we are already paid at 20. So we have 2022 and we have 2020 what? Sorry. The cash flow is 10 million, is 8 million, is 6 million. Our discount factor is what? Our discount factor is 11%.
11%.
Okay. So we have our discount factor to be 11%. So let's do it. So it will be, let's calculate that. 1 over 1.11. I'm getting 0.901 for the first one. Is that correct?
Yes.
Okay. So the second one is what? I'm getting 0.812.
Is 0.909 or
Yeah, we are doing it 3 decimal place. So you can say the last 0 9 there. Okay. The second one is it correct? 0.812.
Yeah, it's correct.
Okay. Then 0.731.
7331. Yes.
Okay. 0.731. You see, someone can also decide to calculate a lease liability like this. We don't have a problem. But the lease liability is always calculated on the amount that you are here to pay. So someone can also have the years that a person will have 2020, and a person will have 12 million. But for the 2020, the discount factor will be 1.00 because we are doing this in what? At the beginning of the 2020. And you have paid the 12 million at the beginning of the 2020. So the present value of the 12 million at that date is the same as the 12 million. So you can do this before you bring the rest. Okay. But if you're also going to calculate your interest, it means that you have to take the 12 million from the amount that you have calculated as a liability before you charge the interest, because the amount is paid in advance. So we do the two. Let's just try the two and see. Okay. So the first one, it will be 10 multiplied by 0.901. I'm having 9.01. Okay. 8 multiplied by 8 multiplied by
6.496.
6.496. Okay. So let's make it 6.50. Okay. So let's look at the last one. 6 times. So, okay.
4.39.
Let's come here. The 2023, we are going to pay the termination penalty. So this was supposed to be 7. Okay. Because we are terminating, so we pay 1 million in addition to this one. So this is supposed to be 7. I hope we have gotten the 7. How we got the 7. It will be the rentals, which is 6 million, plus the what? The termination penalty of what? 1 million. So at the end of the 2023, we are paying what? Two different what? Amounts. 6 million for the rentals and 1 million for the termination. Are we okay? All right. So we have,
But Linus,
yeah.
Can you still please use the 6 times the 7.31? When you get the
Okay.
total, you can still add the 1.
Now the one to you
I'm
present
not-
value the one.
You present value the 1.
Because it will be paid at the end of the 2023. So you can do the 6 first, then you bring the 1 to multiply it by the 0.731. Okay.
Okay, all right. Okay.
But you have to know that you are in the exam hall, so just do the easiest one and move on.
The easiest one and move on. Yeah.
Okay. So 5.12. Okay. So what is our total figure?
$20.63.
Okay. 20.63. Okay. So I'm saying that what you have to do is that, you see, this is the amount that you are here to pay, isn't it? Okay. But you have already paid what? 12 million. So you add a 12 million. So it means that in all, the total amount that you're supposed to pay is 32.63. Do you get this? Do you get the 32.63? It means that in all, the total amount that you are paying for the asset is 32.63. You have already paid what? 12 million, and you are owing what? 20.63. This is the amount that you are here to pay. So this is what I'm saying, that someone can decide to use the 12. The 12 will be for 1.00 because we are doing this at the beginning of the year, and the 12 million is paid at the beginning of the year. So the present value of that amount is still the 12 million. But the lease liability is always calculated for the amount that you are here to pay, the amount that you are owing. You have already paid the 12, so the 12 you are not owing anybody. Okay, so the lease liability will be 20.63, but the right of use will be this. The right of use will be this amount. It will be the lease liability, the amount that we are here to pay, which is 20.63. The 20.63 is the amount that we are currently owing. We are currently owing the lessor. But we already paid what? 12 million, isn't it? We have already paid 12 million. Is that the case? Okay. If you are currently owing someone 20.63, but this is after you have paid what? 12 million. So you are giving 12 million to the person, but you are still owing the person 20.63. It means that the total amount of the goods that you are buying from the person should be how much? You have paid 12 million, but you are still owing what? 20.63. So the total amount that you're supposed to pay for the thing that you are taking from the person is supposed to be how much?
Supposed to be 32.63.
So the right of use, we add advance payments. It means that the total value of the asset, is 32.63. That is the total. Someone, I'm in class.
That will be the total the right of use.
But we add the direct
Right.
cost. We are here to add a direct cost.
Okay.
Okay. So if there is no direct cost, this will be the total value of the right of use. This is the total value of the asset that we are buying. Because it is the asset that we are currently owing the person 20.63, but we have already paid 12 million. It means that the total value of the asset that you are taking from the person is 32.63, out of which you have already paid what? 12 million, and you are currently owing what? 20.63. So what you do is you now come and add so these two is just like the purchase price of the assets. So the direct cost is the handling cost, any other cost that you incur to bring the asset to the state that it is ready for use. And that cost is what? How much is that particular cost?
Direct cost is 3 million.
3 million. The lessor is not paying any part of it. Okay, so since the lessor is not paying any part of it, the total right of use will be 35 point what? 63. Okay, so this is how we determine this. Then we look for the subsequent measurement because the question is asking us to do this at the end of the year or something. So this is December. So all these things are done at the beginning of the year. So what are we going to do subsequently? Subsequently, the lease liability must be amortized. The lease liability must be amortized, and the right of use must be what? Depreciated over 4 years. Okay. So let's come to the lease liability. Subsequent measurement. We have the lease liability, which will be amortized. So the lease liability will be amortized. Okay. So we are doing this for only 2021. So since they are not asking you to do it for so many years, so you can decide not to draw the table. We draw the table when we are doing it for what? Maybe more than a year, so that this will be very simple for us. So we can look at the lease liability at the beginning, at start. Lease liability at start. Okay. So let's put the currency here in million. Okay, what is the lease liability at start? 20.63, isn't it? All right. Our finance cost. Is supposed to be 0.11 times 20.63. Okay. So what are we getting? Getting 2.27. Is that the case?
Yes.
Okay. So what will be the total? I'm having 22.9. Let me check again. 20.63 plus.
Yeah, line is correct, 22.9.
Okay, 22.9. You can see that this one, the rentals will not be paid at the end of the year, isn't it? So you just leave it. So this is the lease liability. Okay, someone can also do this like this. Let's look at this. Someone can also do this like this. Someone can also have the 2021 and have the lease liability like this. 32.63. Then what the person will do is that rentals, because the rentals is paid in advance, the person will take 12 million out of it. Then the person will now get 20.63, and the person will charge the finance cost on it. 2.27. So the person will have 22.9. That's how the person would. So the person can take the total lease liability. That is the amount that we're supposed to pay the people. But we have already paid 12 million. So we take the 12 million from this. Then we charge the interest on the remaining amount. Something like this. We are okay. So this finance cost will go to profit or loss. Then we come to the right of use must be depreciated. So depreciation of the right of use. So the depreciation will be 35.63 divided by 4 years. because the lease period has now reduced to what, 4 years because of the termination. So how much are we getting?
So please, where from that 35.63?
We have calculated the right of use. Okay, let me show you this one. Can you see that we have the lease liability plus advance payment plus the direct cost? Yeah.
Yes, please.
Yes, that is the right of use. Okay.
So it's 8.91.
Okay.
8.91.
Okay. 8.91. This will also go to profit or loss. Okay. Okay. Then let's come to statement of financial position.
Please, kindly go back to small. I want to announce something.
Okay. Okay. Your attention should not be on. Let me copy the solution. Understanding is better.
Please,
Yes, senior.
it's 8.84.
Are you sure? It's 8.91. It's 35.63 divided by 4 years, not 6.
Okay.
We are terminating at the end of the 4th year. So the lease period is now what, 4 years. Yeah, the person who wants me to go back so that he can see something. Either. Someone say I should go back so that he will see something. Are you done with the scene? All right.
I think the person is done.
Okay, let's come to statement of financial position. State of financial position, we are going to have non-current assets.
Hello.
Yes, senior.
Yes, I'm saying that. So after calculating the right of use, so the next step is the subsequent measurement, right?
Exactly.
Okay.
So all those things that we have done, the lease liability, are all done at the inception of the lease, the date that the agreement was made. So we have done all those things at the beginning of the year. So at the end of the year, what will happen? So what we have done right now is at 31 December 2021. But the calculation that we have done for the lease liability, the calculation that we have done here, this one is at January, the start of the year. This is also the start of the year. But at the end of the year, what will happen? So these are the subsequent measurements. Subsequent measurements are at the end of the year. All right.
Okay. Thank you.
All right, you're welcome. So this will be 8.91. We have used part of the asset. So there is 4 years, but we have used 1 year out of it. So it will be remaining 3 years. So the right of use will be the cost minus the what? The depreciation or the accumulated depreciation. All right. So if you come to the lease liability, you are owing the person, so it's a liability. But what we do is that you can decide to show all the 22.9 as non-current liability, or you can also decide to split it if you can do that. If you can show part of it as current liability and part of it as non-current liability, that's no problem. If you can't do it, just show all as non-current liability, no problem. So let's have the current liability, which is lease liability, the lease liability. Okay, so the total is 22.9. Okay, 22.9. So what will happen is that, okay, let me just take this one off. The total is 22.9. Okay, the total is 22.9. But at the beginning of next year, how much are we going to pay? At the beginning of next year, how much are we going to pay? Hey, they're asking us to do this for the year ended 31 December. So this is for 2 years. Sorry. So the first one that we have done is the first year. Oh, sorry. Okay. This is for 2020. This is for 2020. Okay. Let's count to 2021. Let me show 2021. So the 2021, we are going to have our lease liability of 22.9, but we are going to pay the rental of 10 million. So our liability will now be 12.9. So we calculate the finance cost on that. So finance cost will be 0.11 times 12.9. So that will be the finance cost. Okay. So that will be the finance cost. This one is not anything. You can see that at the end of the year one, the total lease liability is 22.9. But immediately at the beginning of the second year, which will be 2021, we are going to pay 10 million. So it means that our lease liability will now reduce to 12.9 at the end of the year. We charge the interest on that. Then that will go to profit or loss. The depreciation will still be the same because we are using straight line method. So depreciation will still be the same for 2021 because it's straight line method. So if you come to, so since they are asking us to show for 2021, are they asking for comparative? Okay, there is no okay, including comparative figures. Okay. So including comparative figures means that we should show for both 2020 and 2021. So let me just show it here. So let me show statement of profit or loss. Statement of profit or loss. So let's have 2021 here. Let's have 2020, which is the comparative. So we have the finance cost to be 2.27. This is not 2.27. 2020 is the 2.27. So 2.27. Okay. 2021 will be the 11 multiplied by 12.9. So 12.9. That will be 1.42. These are all costs. Then we have depreciation. Depreciation will still be 8.91 because we are using straight line method. Okay, let's count to statement of financial position. So right of use, which is the asset, will be 35.63 minus 8.91. That is the first one. So we have 26.72. So it will be the cost minus the depreciation for the first year. No, this is for 2021. This is for 2020. So 26.72. So this one, the depreciation will be for 2 years, 8.91. So we have 17.81. Maybe let's count to current liability for the lease. This will be 10 million, which is the amount that we are paying immediately next year. and this will be for 8 million, which is the amount that we are paying in 2022. Okay, then we come to non-current liability. Non-current liability, this will be this will be 12.9, which is a 22.9 minus the 10. Then 12.9 times 1.11 minus 8. This will be 6.32. All right. $641. Let's try to take the last one. Let's try to see whether if you can finish all of them. Okay, the II. The II. Let's try and see whether we can finish the II. The II. On 1st May 2021, OL entered into an arrangement with Enetic Limited for the use of 5 photocopy machines for a non-cancelable period of 3 years. Semi-annual installment of 2 million is to be paid in advance. As per agreement, AL has a substantive substitution right to replace the machines. What type of lease is this? Which type of lease is that? Which type of lease is this one? This one.
Finance lease.
Are you sure?
It's operating lease because the company that's renting it still have the right to replace. So.
Yeah. So is the lessor who has the right to replace the assets? Is the lessor who has the right to replace the assets? So this is what? This is an operating lease. But the lease period starts from when? The lease period starts from when? When are we starting the lease? It's 1st May 2021, isn't it? 1st May 2021. Is that a date?
Yes.
Yes.
Okay. So from May to December, how many months is that?
It's 8 months.
It's 8 months.
Okay, 8 months. Okay, that is 8 months. So it means that we have consumed only 8 months of the what? Of the lease period. But what are they saying? They are saying that the lease period is 3 years. Semi-annual installment of what? 2 million is to be paid in advance. Semi-annual installment of 2 million is to be paid in advance. So how much are we paying for the 3 years? What will be the total amount for the 3 years? What will be the total amount for the 3 years?
So 3 million.
Are you sure? Semi-annual payment is what? Is every 6 months we are paying 2 million. But the lease period is 3 years. So how many 6 months do we have in 3 years? How many 6 months do we have in 3 years? Every year, how many times
12.
are we going to pay?
So we're paying 12.
Okay. So for 3 years, that will be
12.
okay. So that will be 2 times what? 2 times 6. That will give us 12 million, isn't it? All right.
Yes.
So in actual sense, this 12 million should be spread over what? 3 years, isn't it? So the 2021, the rental for 2021. Let's calculate the rental for 2021. So 2021, the rental will be. So it means that every year we are consuming 4 million.
Please, which question number?
Is the question is the II. the Roman number 2. The same question that we have solved, there's a Roman number 2 there. Question number 3, Roman number 2. This one. The one that I've cycled here.
Okay, sir. Thank you.
So it means that we are paying 12 million in all, but this 12 million will be consumed over what? 3 years. So every year we are consuming what? 3 million. But in the first year, 2021, we have used only what? 8 months. We have used only 8 months. So what will happen is that we are going to have the calculation of the rentals that will go to profit or loss will be the 12 million divided by 3 times 8 over 12. Do we agree? Do we agree to that?
Yeah.
Okay.
Yeah.
So how much are we going to get for every year? For this year, 12 over 3 times 8 over 12.
I'm getting 2.66. What is correct? 2.7.
2.7. Okay. Or let's make it 2.67.
Somebody should confirm.
Oh, I've confirmed that.
Okay.
Okay. So the figure that will go to profit or loss supposed to be 2.67. But this is the portion of the renters, or this is the portion of the asset that we have consumed. All things being equal, we're supposed to pay to the people 2.67. But how much do we pay? How much do we pay?
2 million.
We pay only 2
No,
million.
we pay 2 million in advance, yes.
Yes. So every 6 months we pay the 2 million. So annual payment of this will be paid in advance. So it means that at the beginning, at the inception of the contract, we have already paid what? Okay, so we are paying 4 million. Look at it again. The 2021.
Yeah, so we're paying 4 million in a year because of the semi-annual. Yes.
Yeah. So at the beginning, which is the May 2021, we have already paid what? 2 million. After 6 months, we will pay what? The next 2 million. Okay. So the total payment for this year, total rental payment for this year will be the first one at May, and the next one is what? Is maybe after 6 months, that would be maybe October, at the end of October or at the beginning of November. Okay. So if they say that you are paying in advance, it means that January you pay the first one, July you pay the second one. Okay, that is the semi-annually in advance. So instead of you paying at the end of the 6 months, which is June and December, you are paying June at the beginning and you are paying December at the beginning of the second 6 months. So you pay the first one, May 2021. After 6 months, then you pay that one also to be what? 2 million. So that you are paying 4 million in a year. So the total payment that we have made, total payment is 4 million. Okay. So it means that we have paid some amount in advance. So payment in advance will be 4 million minus 2.67. And that will give us 1.3 or something. 2.67 minus 4 million. 1.33. So if you go to your profit or loss accounts, you only show the portion that you have used for the year, which is 2.67. Statement of financial position, you show current assets of the advance payment, 1.33. So this will be expense, and this will be current assets in the statement of financial position. That is all about this one. Let's see whether we can finish the second question. Let's see whether we can finish the second question.
Oh, you got blue.
Okay, compute the guaranteed residual value estimated by FB at the end of the 6 years if FBL had incurred 2 million of the initial direct cost. So the direct cost is 3 million, but they are saying that if the lessor has incurred the 2 million of the initial direct cost, if the lessor has incurred 2 million of the initial direct cost, what will be the unguaranteed residual value? You see, most cases, the lessor will only reimburse. The lessor will only reimburse part of the initial direct cost incurred by the lessee if the lessor is certain that maybe at the end of the day, the asset, we are going to sell it for a certain amount. We are going to have some money from it. So since the asset at the end of the lease period, we can sell it for a certain amount, or we are going to get a certain amount of it. Okay, we can decide to what? Settle the part of the cost that you have incurred on the assets. We can decide to settle or pay parts of the cost that you have incurred on the asset, because at the end of the lease period, we can sell the asset for a considerable amount or a residual value. So the lessor in most cases will only reimburse part of the initial direct cost of the lessee if they are certain of any residual value that they will be getting from the asset. But if I'm not going to get any value from the asset after the lease period, that is the end of the asset, why should I pay part of what? The cost that you are incurring. So the asset is going to give me, after the use of the asset, I'm going to get an amount from it. It means that the asset is in your care. If you take good care of it, at the end of the lease period, I can sell it. But if you don't take a good care of it, I will not be able to sell it. So what will I do to motivate you? I will try to pay part of the initial cost to motivate you so that you can take a good care of the asset. At the end of the lease period, then I'll also sell it. So that is all about the reimbursement of the initial direct cost. So the question now is, they say you should calculate the guaranteed residual value estimated by these particular people at the end of the 6 years if they have paid 2 million of the initial cost. The 2 million over here is the present value of the amount that what they are paying. So it is the present value of the unguaranteed residual value in the future that they have paid here. So what we do is that we just find the future value of this 2.2 million. That is all. So let's find the future value of that. This is financial management. Let's find the future value of that. The future value of this one is the same as how we do compound what? Interest. How we do compound interest. How we do compound interest. So the future value is calculated as the present value multiplied by 1 plus r exponent n. So our future value is equal to the present value of 2 million. I'm not doing already. Can you pull a home? So 2 million into bracket 1 plus the the interest rate, which is 0.11 exponent 6. They're asking us 6 years. So 2 into bracket 1.11 exponent 6. What are we getting?
3.74.
Getting 3.74. Okay. So this is a unguaranteed residual value. That's all. That's all. Let's see whether we can 655. Hey. Okay, let me just explain the second one so that we end it here. Let me explain the second one. So the second one, they are saying that therefore, on 1st January 2020, Deto Limited DL acquired a machine on lease from Lifeboy Leasing Limited, which is the LLL, for 3 years. The first annual installment amounting to 35 million was paid on 1st January 2020. This is payments in advance, and all subsequent annual installments are payable on 1st January, subject to increase of 10% each year. So how much did we pay right now? How much was paid on the
35 million.
35 million? Okay. The next one will be how much? So 2020 was 35 million. 2021 will be what?
38 million point five.
38.5 million. Okay, 2022 will be what? This will also increase by what? 10%. Are we okay? Okay. So every year you increase it. DL incurred initial direct cost of 5 million as an incentive to DL for entry into the lease. LL reinvest 2 million. So it means that the initial direct cost will only be 3 million. It is 5 million, but the lessor has reinvest 2 million. So what will happen is that the actual cost incurred by the leasee is 3 million. That is what you are going to use if you are calculating your right of use. LL has incorporated an implicit rate of 11% per annum, which is not known to DL. So the interest rate that you are going to use, or the discount factor, is the 11%. Okay. The residual value at the end of 3 years is estimated as 30 million, out of which DL has guaranteed 20 million. So if you are calculating the lease liability, you use the guaranteed what? Residual value of 20 million, which will be at the end of the 3 years. So you also factor that in the calculation of the lease liability. DL is also obliged to incur decommission cost of 4 million at the end of the lease term. Discount rates may be assumed wherever required but not given. So discount rates for the decommission cost is 12%. So this cost will be incurred at the end of the lease period, which is 3 years. So the 4 million will be incurred at the end of what? The 3rd year, which is a future value. So you present value this and add the present value to the right of use. Then you now take the present value as a provision. Then at the end of every year, you compound or you unwind the provision. That's all. That's all about this one. So you can see that we have a combination of a lease and 37. We have a combination of a lease and 37. So this is the 37 in IFRS what? 16. Seniors, this is how far we have come. Okay, so today we look at lessor accounting and leasee accounting, the basic ones. Next week we look at what? Sell and lease back, where the person, you have the asset there, although you want to use the asset, you really need to use the asset, but you don't have money to. So what you do is that you sell the asset to someone to get money and try to what? To lease it back and use, because if you lease it back, they are going to give you a flexible payment terms. So if you sell the asset for 100 million, if you lease it back, you are not going to pay, or you're not going to give all the 100 million to the person. You'll be paying in installments. So you can use, maybe if you lease it back, you are paying 20 million in advance. you're only going to pay 20 million out of the 100 million. You use the 80 million to do whatever you want to do. So the sell and lease back, you have the asset, you sell it, and you started to, or you want to lease it back and use again. That is sell and lease back. Reassessment of a lease liability is a situation where the lease liability or the rentals will be based on certain things, inflation or certain things. So at the end of every year, you have to reassess your lease liability. So even the discount rate can change, the years can also change. That is also part of the reassessment of the lease liability. Any factors that we use to calculate the lease liability can be subject to change. If that happens, what do? We look at that next week, Saturday. Thank you all for coming. Any question?
There.
Yes, yeah.
This question, we will try. I will try one hands, but I believe you will solve it and put it on the page, so that we can compare whether we are right or wrong.
So you should solve it first before me. I'll come with my own.
Oh, solve it first. Solve it first.
No. You should solve it first.
So we beg.
Let me say we don't read answers, and we beg.
We beg.
No.
We beg.
We are all begging.
Hello, sir.